Okay, good, good. Great. All right, so we are going to start our webinar today. So on your right side of the screen, there is a bubble with a question mark in it. It's basically if you have any question, just type your question in the bubble and we will answer them periodically every like 10, 15 minutes. This webinar shouldn't be long. It's roughly between 30 minutes, 1 hour. Today we are going to be learning about the different types of charts, and we're going to be learning specifically how to trade using Japanese candles and Japanese candles patterns. With you today is Gabi Dahdu. I am the Chief Market Analyst in One Trading Markets. I have multiple degrees in finance, risk management, fundamental analysis, technical analysis, and risk management for investing 010. All right, so let us begin our webinar today. So here we go. Let me put the slideshow here. Okay, so today we start with the basic types of charts. So in any types of trading, if you're talking about stock trading, or if you're talking about crypto trading, or if you're talking about currency trading, they always use three types of charts: a line chart, a bar chart, and a Japanese candle chart. Now we're gonna go fast through the line and bar chart. I'm gonna explain to you guys what they are. Then we're gonna go in depth into the Japanese candlestick chart. Now, what is a line chart? This is what a line chart usually looks like. You guys can see here, just a line. It represents movement of a specific asset or currency. And here is the explanation for it, basically. A line chart graph is a type of chart used to show information that changes over time. Line charts are created by drawing a series of several points and connecting them with a straight line. And line charts are used to track changes over short and long periods of time. Now, what does that basically mean? Let me show you here my drawing skills, and I'll explain this over paint. All right. So watch this. If we have, as we learned in school back in the day, we always have, for any type of chart, you have two lines, correct? The first line, the horizontal, and the vertical line. Sorry about my vertical line. Here we go. So as you all learned, we always remember that the vertical line basically the vertical line represents the asset value. So here is the value. Okay. So let's say $1, $2, $3, and $4. Okay. Now the horizontal line basically represents a period of time. So let's say we're using a daily chart, which is basically 1 day each day. So 1 day, 2 day, 3 day, 4 day. 1, 2, 3, and 4 days. Okay. Now let's say we're looking at a specific stock. Okay. So the first day that would happen, basically the stock closed at $1. Then second day it closed at $3. The third day it closed at $2. Then the fourth day it closed at 4 hours. So basically, when we're talking about a line chart, it's only the problem with the line chart is that it only shows us the close value of that stock. So basically, it shows that the first day the stock actually is worth $1, and it shows that the second day is worth $3. So if we connect these with a line, we come up with a line chart. But here's where the problem is with the line chart. It doesn't show me the ranges of the stock or currency that we're studying, how much it moved each day. So like in the first day, the stock could have went like up to $2 and went down to like half a dollar, then it closed at $1. And that's where the bar chart comes to help us. That's where bar chart comes to explain how the market is actually moving. Now imagine with me that we're zooming in on this exact point. Okay, we're zooming in. And we have another chart. But in this chart, we have hours: 1 hour, 2 hour, 3 hour, 4 hour, till 24. And same here, we have $1, $2, $3, and $4. Now in the first hour, let's say the stock was at $1. Second hour was at 3, third was at 2, the fourth was at 4. So basically, by combining this line together, we come up with an idea. This idea is called the bar chart, which basically is drawn like this. It's just a line basically. But we got to understand where the market opened and where did it close. So we represent the opening of the market with the left line and the close with the right line. And this is basically what is a bar chart. This horizontal line basically, sorry, vertical line, shows that the ranges of the stock, like it reached $4, like the top is $4, the bottom is $1. But the closing price, let's say it's $3, so here will be 3. And it opened at $1 or like a dollar and a half, so this will be a dollar and a half. And this is how bar charts simplify and try to explain how the certain stock or a certain commodity actually moves during the day. Now, what the Japanese did is basically they drew a body on this bar chart, and it became what we all see as a candlestick chart. Now, the problem here was that they didn't know which candle represents the market going up or the market going down. So they came up with the idea that if the candle is drawn with a red color, it basically means that the market has dropped in value. And if the candle is drawn with a green color, it basically represents the market going up. So there you go. It's very simple. I hope nobody has any questions so far. Anybody has any question about the types of charts? Okay, great. So let's go back to our presentation and continue this. So let me remove my painting skills. All right. So as you can see here, this is the line chart like we talked about. It's very simple. And here is the bar chart. Now, why did they come up with the Japanese candles? Because bar charts, when you look at the graph that's very long, it's very misleading to the eyes. So it becomes very disoriented. Your eyes will be very confused. Let me show you here real fast on our trading platform for one trading market, sorry. So this is what a bar chart looks like. You see what I mean? It's very confusing. So the eye doesn't feel comfortable looking at a chart like this. And that's where the idea for Japanese candlestick came from. So when we look at a chart like this, you can understand when the market is going up, when the market is going down, when is the open price, the close price, etc. All right, let's go back to our presentation. Here we go. All right, so now we start with the structure of the candlesticks, okay? Now, 4 elements you always got to remember. There are the high price, the low price, the open price, and the close price. High price, low price, open price, and close price. So notice with a green candle, which basically represents the market going up, the open price is always in the bottom, and the close price is always at the top. But with a bearish candle, or what represents the market going down, the open price is on the top, and the close is on the bottom. These here we call a shadow or a wick. They basically represent the ranges where the stock or a certain commodity actually traded during the day. And we have one more thing to know before we actually start understanding different patterns. This is called a doji. A doji represents indecisive kind of statement in the market. So neither the buyers or the sellers understand what's going on in the market. Nobody can take control. Nobody can change the trend upward or downward. It basically had the same open and same close price, but during the day, it kind of traded up and down. This is what we call a doji. So the different types of candlestick chart patterns. Now, as you can all know, basically when we look at a candlestick, we got to understand the pattern. That helps us predict how the market will actually move. Now, nothing is 100% always in trading. Market actually moves left and right all the time, but these have they are very good tools to help us understand how the market is actually moving. And it helps us minimize our risk to make better choices while trading. Now, we have 2 different main patterns. We have reversal patterns and continuation patterns. Now, what are these? Reversal patterns, basically, it means that the market is going one way, then we see a certain pattern, then we can anticipate that the market will reverse in pattern. For example, let's say the market is going up or in a bullish move. So we see a certain pattern that represents a reversal. We know that the market has a very good chance of actually going down to a downtrend. A continuation patterns is the other way around. Basically, we see a market going up, and we see this pattern, and we understand basically that the pattern will continue its upward movement. Now, these are divided into bearish patterns and bullish patterns, which are we going to explore next. Any questions so far about any of the information? Okay, I see your question. So it's basically like this. What I mean by bullish or bearish. In the stock market or any kind of market, to be honest, trading market, we have two terms that you need to be aware of. A bull basically represents the market going up. A bear basically represents the market going down. So when I say bullish candle, bearish means it's going down, bullish means it's going up. Was that clear? All right, good. All right, so let us start with candlestick patterns. So here are the bearish pattern. These are all the bearish patterns. Now, you don't have to memorize each one because it's going to take a lot of information. It's going to take a lot of study. You don't have to do that. But when you understand the logic behind them, basically, when you start looking at a chart, you can tell yourself that, okay, I know what this means. I know what this means. And you can start actually trading with better profits. Let me explain to you here. So the first pattern is called the hanging man. Now, why is it called the hanging man, basically? Because it looks like a man who's hanging. Like this is the head basically on top here, and this is the body. Now, what this represents, look at this. We have an uptrend going from here to here, okay? So let me put my laser pointer so you guys can see better. There we go. All right. So, okay, this is a hanging man. So this is the head and this is the body. So notice how we're having an uptrend. And then we have a small candle, but with a big, long underwick, like an undershadow. Now, what does this represent? It represents that the sellers are trying to bring the price down. So this is the wick to the bottom. It means that the sellers are putting forces into the market to draw the price, actually drop the price. And this basically tells us that because the buyers has no upper wick, that the buyers has technically no power right now, which basically drives the market into changing from an upward movement to a downward movement. And this is the logic between, like, we just gotta understand how the wicks, how the body actually works. And you'll see, like, you can open any chart and it's gonna be very simple for you to read. Like, look at here, this is called a bearish engulfing. Now, there's two types for this. There's a bullish engulfing, which represent the market going up, like we said. A bearish represent the market going down. Now, notice here how we are having an upward movement with, at the end, with a candle that is green, which basically represents the price going up. Now, the next day, it started with a gap. Like we said, the green candle, it opens in the bottom, it closes at the top. But the red one, it opens on the top and closes in the bottom. Now, notice how the next day started with a gap here. And it dropped all the way down and closed up beyond the open price of the first candle. So basically, if you look at it like this, it basically ate the previous candle. So this candle was so big that it actually ate the previous candle. This is a very common, very common candlestick pattern. You will see it a lot, and it actually has a lot of proven and technical and mathematical way to prove how this pattern actually works. Basically represent how the sellers have so much power that they actually covered all the buyers' power before. Now here is another variation, but it's a little bit different of the same pattern. Now here it started the same. So an upward movement, a gap where the market actually opened above the previous day, but the price wasn't able to drop down all the way, but it dropped above 50% of the previous candle here, which also signals how the sellers or bears have a lot of power that could drive the market into a downward movement. And that's exactly what happened. Notice how the market actually went down. Now, a shooting star, you're going to see this a lot. It's very important to actually notice a shooting star, because if you see a shooting star in an upward movement or a bullish basically trend, it could be a very strong indicator that the market will change soon. And you can actually exit your trades or enter new trades and minimize your risk with this pattern. It's very important. Now, it basically represents a small candle, a very small candle at the top of the trend, but with a very strong upper wick, very long upper wick. Now, this basically means that the buyers or bulls tried to take control of the market, but the sell power was so strong that they actually couldn't beat the sellers. So the candle turned into red. And when that happened, a downtrend started here. Are there any questions so far? I hope everything I'm saying is clear. I don't want to confuse you guys. I know this is a lot of information, but trust me, you're going to see it on our live example soon, and you're going to see how simple it is. Okay, so no questions. Good, good. Okay. So this is what we call an evening star. An evening star it's basically kind of like a shooting star, but you got to understand the difference here. The evening star has no wick. Most of the time it has no wick. So we are having an upward movement here. Then we are having one small candle, which is red. Then we are having a downtrend. The next candle gotta be red. You gotta understand when patterns work, they always work in a certain way. So what does this basically means? So you gotta see a green bullish candle, then a red one, then a red one. Then you know for sure that the pattern is actually activated, and then you can see the market how it actually reacts to this pattern. Now, an evening doji star, it's the same thing as an evening star, but instead of having actually a small body candle, you basically have a doji where I told you the market is still indecisive about which direction it will go. The next pattern is called a bearish harami. Now, notice in the bearish engulfing how this candle, the red one, ate the one before. Now, a harami is the other way around. But notice here, the red candle was the one that actually ate the green one, okay? And here we're having an uptrend with a big, strong bullish candle, which represents that the market is in an upward movement right now. But the day after, it came a small candle and it got eaten by the previous candle. Now, what does that basically shows us? Like, if we're looking at yeah, I will show you the example in a second. Now, what does that basically shows us? It basically shows us that the sellers have some power, but they couldn't drop the market yet. Basically, you got to understand the accuracy of patterns and strength is different. So let's say if we have a bullish engulfing, let's say this is a 75% that the market will going down, the bearish harami will be around like 30%. These actually differ from market to market, which we're going to see in a live example soon. Now, the next one is called a bearish belt hold, which basically represents an upward movement with a very strong red candle here. Now, if we connect different patterns with each other, let me show you here. Like here's a bearish engulfing where the red candle ate the green one. And notice here, it's actually the same thing. Like this candle ate this one. But the only difference is we have no upper wick, we have no upper shadow. This is why they call it a belt hold. A belt hold. It has no like zero power from the buyers. It's all selling power, and that's what drove the market down. Excuse me. The next pattern here is called an upside gap two crows. Now, what is that? Like, it's a very weird name, but it basically means two crows are like two red candles that are alone away from everything else. So notice here, this is an uptrend movement, but there's a gap here in price. And then we have two red candles, then another gap. This basically represents a very strong trend that the market will change from a bullish trend to a bearish trend. Now here you can see other actually patterns. Now, the most important one to actually you got to memorize is always the three black rows. Three black rows is very important. It actually has a strength of between 85 to 90% that the market will change. It's basically when you have an uptrend, then you see three red candles one after another. It basically represents how much selling power there is in the market right now. Other ones is dumpling tops. So let me explain one thing to you guys. Dumpling top is basically these small candles variating from up to bottom, from up to bottom. So notice how we're starting with an uptrend, but it's going up and bottom, up and down, up and down. And this is what we call a dumpling top. It represents dumpling, which is an Asian food. I don't know if you guys know it or not, but it's very good. And it represents indecisive in the market. But notice how the last candle was actually red, which showed that the sellers were able to take control over the market, which is why they drove the market down. All right, so on the bottom here, we're going to talk about continuation bearish patterns. Before we look at an example, actually, let us look at one example real quick here. So notice here, this is what we call a hanging man, okay? The market was going up, we saw the hanging man, we know this is a reversal that basically signals a reversal in the trend. We were having an uptrend, now we're having an downtrend. Now, if you look at it at the US versus the yen on a 4-hour chart. Now, what do we mean by 4-hour chart? It basically represents that each candle is 4 hour long. So 4 hour, 4 hour, 4 hour, 4 hour. That's basically what we mean by 4-hour chart. When we look at a daily chart, it basically means each candle is 1 day long. Now, notice how we are having an uptrend right here. The market is going up. We can see higher tops, higher bottoms, and we notice this candle right here, a hanging man. And we already know that the hanging man represents a reversal in the current trend. So we sell. When we sell, notice how the market actually dropped down all the way to the bottom here. And that's how candlestick actually work. They work in a way that helps us understand and predict the market, that helps us understand psychology behind the buyers and the sellers. Let's go back to our patterns here. All right, so here we have a few patterns that are a continuation patterns, okay? Continuation pattern means that the market will continue in the same way that the market actually began with. So, for example here, the following three methods, okay? It's basically, we're having a downtrend in our example here, okay? And notice how we have 3 green candles. This is why they call it falling 3, because these 3 tried to get up, like they tried to increase the buyer power in the market, but they couldn't. So a big red candle, then 3 green small candles, then another big red candle, basically represent that the sellers hold total control over the market. The buyers have no way to take control to increase the value of the stock or currency, etc. Now, let's look at separating line, bearish separating line. Notice how the market is going down, but then we have a green candle, which shows that the buyers are trying to get in. They're trying to gain control over the market. But the next day, okay, the price opened at the same line where the price closed. So notice here, this is the open, this is the close, correct? Now here's the open, here's the close. So they started at the same line. And this is what we call a separating line. And this basically means that the market most likely will continue its downward movement. Now here we have bullish patterns. Bullish basically means that the market is changing direction from bottom to top, always. Let me remove this, okay? Okay, hold on. Before we start with the bullish pattern, are there any questions about any of the patterns? Are you intrigued by any of them? We're still gonna look at a real life example at the end, like live, and we have a few examples here that you're gonna see to explain how these patterns work. Mm-hmm. Yeah, sure. Okay. So this one, right? Okay. So bearish kicking basically means that the market is showing different directions to the trend. Now notice with me here how we're having an uptrend with a wick here that shows selling power, okay? Sorry, buying power. But the next day started with a gap. Now, what does a gap mean if you're not familiar with this term? Basically, it means that the market didn't start the next day or the next candle where the previous day has ended. So let's say the market it moved from 133, it reached $5, okay? But the next day it didn't start from $5. It actually started at $7. There's a $2 gap. That's what we call a gap. Exactly. Yeah, so this gap here happened, and the next day we have a red candle with no buying power but all selling power. Basically represented that the sellers took control, and that's the result, going from an uptrend to a downtrend. Yeah. All right, let's talk about candlestick patterns, the bullish patterns here. Okay, so the first one we need to know is called a hammer. Now it's called a hammer because it looks like a hammer. Notice here, this is the head and this is the body. It basically looks like a hammer. And it basically represents a lot of, like, notice how the wick is very, very long to the bottom. It shows a lot of selling power. Like people try to sell and sell and sell and sell to drive the price to the bottom, but they couldn't. Like the candle actually closed at a green color, which basically means that the buyer power are still very much strong and they're gonna drive the price back up. And that's exactly what happens when you see a hammer pattern. You notice a downtrend, then a hammer, then an uptrend. It's always gonna be like that. Now, we talked about the bearish engulfing. Now let's talk about the bullish engulfing. Now notice here in the bearish engulfing, the first candle is green, the second candle is red, okay? Here, it's the other way around. The first candle is red, then the second candle is green. It's the same logic. Notice how the market actually opened above the first candle and below and closed below the first candle, and it kind of like aided. It like covered it entirely, which basically supported the buyers in their decision to increase the value of the stock or currency that we're actually analyzing. Now, an inverted hammer is basically just like a shooting star, okay? But a shooting star, we see it like here, we see it on an uptrend. So we see it at the top. An inverted hammer is actually, we see it in the bottom, which shows how much power like the buyers are actually holding right now. Like they try to increase the price, they couldn't increase it all the way because we didn't like as you can see, the body of the candle didn't actually move a lot, but they increased it to a certain amount that the candle actually closed at a green light. A morning star, like see here, we have an evening star, okay? A green, red, red. You gotta remember, green, red, red. A morning star is the other way around. It's a red, green, green, which is basically the same. It shows us how the market was going in a downtrend. Then we have a small green candle, then another green candle, but this one is kind of far away. It shows how the psychology of the people changed from a bearish kind of way to a bullish kind of way, which indicates that the market will go up in the near future. Like it's basically a turning point. It's a signal for us to understand that this is a good place to buy. All right, let's look at some continuation patterns here as well. For example, let me show you this one, upside Tasuki gap. Okay, so notice how we're having an uptrend. Okay, so we're starting with an uptrend. So this day started with a gap. Notice the gap here. Yeah, it started with a gap, but then it dropped down, but then it went up again. This basically shows us that the sellers, which is the color red, are trying to bring the market down, but they couldn't. They tried to cover this gap. They tried to go down all the way to the bottom, but they couldn't. There was so much buying actually pressure that it actually increased the value of the market, and the market stayed bullish and kept going up and up. Same here, the rising three methods. So the rising three methods basically represent a very strong and big green candle. Then we have three red candles. Now, if you remember in our here, we talked about the falling three, correct? Yes, exactly it's the same. So basically a very big red candle with some buying power, like the buyers are trying to take control over the market, but they simply couldn't. So the market actually closed at the fourth day with a red candle, which drove the price down. Now here it's the same way. Notice how we're having an uptrend, a very big green candle. Then the sellers tried to get in. They tried to bring the price down, but all their candles are small. They don't have enough selling power to actually drive the price all the way to the bottom. And in the last day of the pattern, we notice a big bullish green candle, which shows us that the seller couldn't actually, their attempt failed. They couldn't drop the price or change the direction of the market and so on. So the market actually continues its way up. Now, let me talk about other patterns here. For example, the tower bottom. Now, what is a tower bottom? And we have here a tower top. So imagine with me, these are the pillars of the tower, the big green one, the big red one. These are basically like windows, okay? A tower top is a 5-day pattern. What does that basically mean? So you need 5 candles to confirm this pattern. Now, like I said, if you're looking at a daily chart, each candle represents 1 day. So if we're looking at a 1-hour chart, each candle actually represents 1 hour. So this is a 5-hour pattern, for example, if we're looking at an hourly chart. Now, the bearish one basically starts with the green one. The bullish one starts with the red one, okay? Because we're having an uptrend. This is a bearish pattern, then we're going to have a downtrend here. Here, it's the other way around. We are having a downtrend, and then we are having a then we are having an uptrend. So for example, here, we started an uptrend, and we noticed that there's a big green candle. But after that green candle, there's a few small candles. Now, a small candle, a small body candle is called a spinning top. In case you didn't know, a spinning top is basically just a candle, but with a very small body. Now, the body, like I said, yeah, it's this one. Yeah, that's. So on the last day of the pattern, on the last hour, we notice a big red candle, which basically shows us how the market actually moved. The sentiment of the market actually moved from an upward movement to a downward movement. And the same here, the market was going down. We have a few spinning tops. We noticed the first big red candle, and then we noticed the last green candle here, which basically shows how the market went up. Do you guys have any questions so far? I know it's a lot of information to take, but basically when you start understanding the logic behind the candle, like some people see patterns, they think like, hey, I see a morning star. That means like this is gonna happen. But now when you understand how these actually work, it's so much easier for you to analyze any chart. You don't even have to remember the pattern because you understand what the market actually means, like what's gonna happen next. It helps you predict the movement of the stocks or currencies, wherever you're trading. Any questions so far about this? Yeah, sure. I'll explain it again. All right. So inverted hammer, right? That's the one. Okay. So notice how we're having a downtrend. Now, what is an inverted hammer? Okay. Notice how we talked in the bearish patterns here. We talked about a shooting star. Basically looks the same, right? Like it's a small candle with a very long, higher wick. Okay. So here, basically, the market's going up, but we see that there's a lot of buy power, which basically drives the price all the way up, but they couldn't actually hold the price up. They couldn't close the price here. So it went back down and it turned red. It basically shows the control of the sellers over the market. Now here, it's the same kind of way, but it's in a downtrend. So the market is going down, and we notice a small candle with a very higher wick, which basically shows how much the bulls are trying to take control over the market. And it actually didn't turn red, it stayed green. It showed that the bulls were actually able to take control over the market. And they fought the bears here and they won at the end, which basically suggests for us that the market is changing. The market is going from a bearish trend to a bullish trend. And for us, like if you want to trade and use this type of patterns, we look at the next day. We notice that the next day is having a green candle, which basically means that the market is moving up. That is our confirmation to actually enter a trade here. Yes, exactly. Mhm. All right. So here are just some simple examples about a hammer and a hanging man. The hammer, as I said, the trend is going down. We see a hammer here. It looks like a hammer. That's why it's called a hammer. Let me repeat that. We notice that it's green. Now the white here basically means green and the red means red. But back in the day, they used to use a different software that didn't allow color to be on charts. So now you don't have to worry about this these days. So we notice how the sellers are putting pressure, but the buyers were actually able to take over control of the market. And from here, we can see the market going up. A hanging man is the other way around. It looks like a man who's hanging. This is the head, basically. This is the body. Same way, like look at the pressure that the sellers are putting. They took control over the market, and from there, the market actually went down. Now let's look at this example. Before we go to a live example and actually see how the market is moving. So this is an example for the USD versus the Canadian dollar on a daily chart. Daily chart basically means each candle represents one day. So the first thing we look at is this pattern here. This is a bullish engulfing. Notice how this candle actually ate this candle. It's so much bigger than it that it's actually ate it. It showed that the sentiment of the market moved from a bearish kind of way to a bullish kind of way. So from a downtrend to an uptrend. And after this candle happened, after we see this pattern, like let's say we bought here, notice how the market actually went up. Yes, exactly like that. So basically it represents it's all about demand and supply. Okay. If you demand something, you buy it. That's buy power. See what I mean? Supply basically that's sell power. It's all about that. Now notice here, actually let's look at this pattern here before we go here. What is this? Very high wick, small body. We go back here. Very high wick, small body. Shooting star, exactly. It's a sign for a reversal. So if we go to our example here, we notice a shooting star here. We know that this is a sign for us that the market could changing from an uptrend to a downtrend as it happened here. Notice the next few days had confirmation for us with a bearish engulfing here. Notice how the big red candle ate the small green candle. Okay, now here, what do they mean by not a valid bullish engulfing? Like I said, there are conditions for different patterns to actually happen. Now here, bearish engulfing, basically, it means that this candle, the second candle, which is the red one, ate the previous one. It was so big that it was actually able to cover all the buy power. Now here, it didn't happen. Why? Because notice how, sorry, notice how this candle is very small in comparison with this one. And this one actually started way above the market. So this is what we call a belt line, and you can see it here. Where is it? Hold on, let me show you. So we talked about the belt line, separating line. There we go. Yeah, the separating line. So here we go. See the line? So we talked about how this is basically confirmation that the trend will continue its movement. So a downtrend, green, red, then it continues on its way. Okay, so if we look here, we notice the same thing, red, green, but notice the belt line that actually divides these two. So the market actually continued on its way up, but we have a few spinning tops. Now, if you guys remember, I just want to show you something here. We talked about dumpling tops, right? Where we have a green candle, red candle, and a few spinning tops. Spinning tops, like I said, if you don't remember, basically a candle with a very small body. Now, a spinning top, dumpling top or dumpling top, it basically doesn't have to be 3 or 4 spinning tops. It could be many. For example, here, notice a green one. Then look how many spinning tops we have, like 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So 10 days of actually having spinning tops. The market showing indecisive. It doesn't know if it's going to go up, it's going to go down. Then we notice a big red candle, which we know this basically represents for us a dumpling top pattern, which is a reversal from an uptrend to a downtrend, because we memorize this information. We know what this means. The trend actually moved from up and it started going down. Now let's look at a real life example actually on our platform right here. This is platform that is provided from OTM, One Trading Markets. Now let me show you what a graphic basically looks like before. So chart window. This is what it looks like. Now the good thing about this platform that it actually helps you customize the graph basically as you want. So let me show you here. So this is on the top here, it shows you a line chart. This basically shows you a bar chart, and this shows you a candlestick chart. But notice how it's like very, like you can't understand anything from it. Like you gotta go closer to understand it. So what you can do, you can actually customize your template that actually shows you like the different colors that you want, anything you want basically. See, like templates here. You can customize everything about it. So if you go to properties, you can see the colors. You can put like this one like green, this one is basically like brown. You can customize it as you want. You can change the background, etc. So let's go to my template that I actually have saved, okay, which is here on my desktop. Here we go. So which is this. So let's look at the WTI. WTI, this is in real life, by the way, like real time right now. And notice the different candles. We gotta understand, we gotta look at a few examples how the market actually moves after these candles. So let us zoom in here, for example. Now, what do we see here? Okay, the first thing that we see, the very candle that's very shown is this one. Which, if you remember, we talked about a pattern that's called a harami pattern, which is, let me show you here. Bearish harami. Okay. Notice how it's the same way. The first candle was bigger than the second candle, which basically indicates that the market will go down. And notice how the market actually did go down from all the way here to the here. But after that came another pattern, which is a bullish engulfing. Like we said, the second candle ate the first candle. We see it here. This is the bearish one, sorry. This is the bullish one. A downtrend, like we gotta see all the criteria for the pattern to work. We are having a downtrend. Red candle smaller than the green candle, then an uptrend. Now if you look here, a red candle dropping down, so downtrend. The first candle is red, the second candle is green, and then it reversed the market all the way back up. So let's look at some more other examples. For example, here, this is a very good example for you to see. Now, notice how we're having an uptrend, okay? Then we see one basically candle with a small buy in very high wick. Now, if you remember from the pattern that we saw, what does this basically means? Yes, you are correct. It is a shooting star. Uptrend, small candle with a very high wick, then a downtrend all the way that reversed the market. The same happened here. Notice the market was going up with an uptrend, and we have a small body candle with a very long high wick. Then the market actually dropped down. Like notice this is a big drop. This was basically on a 1 hour chart. So basically each candle represents 1 hour. So in 5-6 hours, it dropped from 82 all the way to 77, which is a big drop if we're talking hourly based. And that's basically it. It's very simple. You just got to understand the logic behind these candles. You got to start, when you're looking at charts nowadays, you'll begin yourself to actually understand how the market is moving. It takes some time, it takes some practice, but this is a very good strategy, especially for a beginner to learn. Okay, hold on. I'll answer your question in a second. So these strategies are very good for you as a starter. It basically helps you understand how the market is moving. It helps you understand the supply and demand. This is basically the baseline where you start investing in yourself, in increasing your knowledge about different markets and market movement and action price. This is the best place to start. Anybody who's actually made any good profit or actually interested in technical analysis or to any different market actually had these information memorized. You don't have to have it memorized because when you start looking at different charts, this information will be saved in your head. It's really that easy. You just gotta start reading different charts and you will see by time you will understand them like right away. Now let me answer your questions if anybody has any questions. I have a question already here. So are these patterns best for 4 or 1 day or a week? Okay. So the beauty of Japanese candle that they work for different time frame charts. For example, if we look, this one is the 1 hour chart. Let's look at the gold and change the time frame from 1 hour, okay, to another scale, which is basically, hold up, hold on. Look here on the left. Sorry, it used to be here. So this basically shows you the time frames for the different charts. This is 1 minute chart, 5 minute chart, 15-minute chart, 30-hour, 4 hour, 1 day, 1 week, 1 month. So the good thing about these pattern candles is that it actually shows you information on different scales. It doesn't just like work better on 4 hour or work better on 1 hour or 1 day or 1 week. It actually works very stable and very balanced on different time frames on all of them, which is the beauty of this strategy. Like notice here, if we're looking at the weekly chart, how we have a Harami pattern here, which basically represent the market going down after an uptrend. Uptrend, Harami, notice how the market actually went down. Notice here how what we have here, which basically a tower bottom, which basically seen here. See, big, small, big, big, small, big, and the market went up. So this is on a weekly chart. So each candle represents 1 week. Yeah. Any more questions? Anybody has any wondering or a question about these patterns? It's gonna take time. I understand that it's gonna take time, but you gotta when you start reading yourself, the strategy actually helps you understand different markets, not just stocks or currencies, even crypto right now. Like all the basic world markets actually work on candlesticks. Well, thank you all for attending. With you today was Gabi Dahdo. Here's my Instagram where I post daily updates for different markets. And here's my Telegram channel where I actually post my free analysis on different markets, whether it was stocks or cryptocurrency or even normal currencies like pair of currencies. I post a very detailed analysis there. Hold on. Okay, I see your questions. You were late about the question, but no worries. Can we use the candlestick to find levels to watch? Of course you can, yeah. But that's a different strategy when you're watching a certain level. So let me explain. Now you're going into basically resistance and support. Resistance or support are basically zones where we have a lot of buy power or sell power. And these candles can actually represent that. So for example, let me show you here on this example. So if we grab a line here, like this, notice how these candles weren't able to go up this line, like it wasn't going to go above this line, which basically represent a resistance line where the sell power is really strong, that the buyers, even if they increase the price, they can't break it yet. That's exactly what happens, yeah. But this is a different strategy for the candlestick, but when you combine them together, which we're going to be conducting a lot of free webinars provided from our company, One Trading Markets. In the next few weeks, I think we have a webinar each week right now, which me and our chief market strategist actually conduct every week. So we're going to be providing you with different strategies every week so you can invest in yourself and in the stocks, crypto, and currencies, and you can make the best profits with the lower risks. So thank you all for, hold on, let me just make sure maybe somebody else has a very late questions. Anybody got any more questions? It's my pleasure. It's of course, my pleasure. All right, so with you today was Gabi Dahdoul. Like I said, this is my Instagram, my Telegram. Thank you all for attending, and you all have a very good day. Take care.